Markets yesterday are just sitting right on top of this 20-day moving average, and we continue just to kind of hold that support. So that's good news here. Here's what you need to know before the bell. Markets aren't doing anything wrong whatsoever. We just kind of continue to drift up this 20-day moving average. So again, there's no reason to be overly bearish right now. We're still on a sell signal from a pretty elevated level, suggesting that prices may be capped here a little bit in the near term. But again, we're defining this kind of rally here. One thing that we've talked about before are these bullish stampedes, where you get just kind of a consistent price rise over a period of time. And we've had a bullish stampede now for quite some time. And these stampedes typically last 15 trading sessions on average. We're well past that. So we're due for a 3 to 5% correction. I know we've said this before, but again, these things, when you have a lot of bullish momentum in the market, a lot of this FOMO chase, that can take a lot longer to, for these corrections to happen. But it doesn't mean they won't happen. So again, a 3 to 5% correction somewhere along the way will certainly give us a better opportunity to put some capital at work in the markets, because again, the trend is clearly higher. Go back to last October, markets were extremely negative. Bearish sentiment was extremely high. Now it's just the opposite. Bearish sentiment's dropping very sharply. Bullish sentiment's getting very elevated. And now you've got analyst after analyst coming out now, posting up new price targets for the year, 4,700, 4,800, all-time highs for the market. This is part of this process. And again, the differential between a bear market and a correction is how fast that you get back to all-time highs. And so, yes, we had a negative return last year, but if we get back to new highs this year, which is what a lot of analysts are expecting, that's a correction. Bear markets typically take several years to get back to new highs. So the difference between a bear market and a correction is not only the depth of the decline, but it's also how quickly you resolve that decline back into new highs. And we're on pace right now. If this market continues in this kind of current trajectory that we have now, we're going to be at new all-time highs by the end of this year, early next year. Clearly an indicator that last year was just a correction within an ongoing uptrend of the market. So again, that bullish dynamic of the market has not changed. But we're now flipping rapidly back and forth between very bearish concerns and very bullish outlooks, and we're now back on the very bullish outlook side of the markets. Again, as I said though, a little bit overbought right now, still well deviated from long-term moving averages. That still needs to correct here at some point. But again, these kind of bullish stampedes, as I said, can last a bit longer than you would expect. So again, be careful getting overly cautious right now. We're clearly in a bullish trend, want to participate with that. But again, this still tends to be, and still is in all regards, a fairly narrow rally. If we take a look at really what's driving the market, 60 to 65% of the return this year has been driven by those top 7 stocks. The rest of the market still trying to make up some of those. And we are starting to see this rally broaden out a little bit, but not there quite yet. So again, just kind of keep a watch here. Earnings season may give us that bit of a correction that we're looking for. We'll see. But again, use opportunities of price declines to add exposure to portfolios rather than being overly defensive and bearish at this point, because again, the market's simply not in that mode. That's what you need to know before the bell this morning.